Welcome back to Return My Capital. Today we're taking a look at seven leading companies from the utility sector. The seven companies will be NextEra Energy, ticker symbol NEE, Southern Company, ticker symbol SO, Duke Energy Corporation, DUK, American Waterworks, AWK, American States Water Company, AWR, American Electric Power, AEP, and Consolidated Edison, ticker symbol ED. We'll take a look at performance, underlying metrics. You'll see some of the similarities between these as they are all regulated utilities. We'll compare as well some of the geographical regions for operation, but we'll get to all that in our utility stock comparison here. So, kicking things off, we've got NextEra Energy, and year to date down 6% over the past year, negative 2%, past 5 years up 18.3, and over the last decade up a whopping 165, which is actually pretty incredible performance for a utility stock. It is trading in the lower half of the 52-week range. It's at 67 today. That 52-week range is just under 62 up to 86. You see the forward price to earnings here, 18.3. Does yield almost 3.4% on that dividend and a negligible 1.7% short interest. This may be the largest of the seven. Let me take a quick look at that. Is NextEra the largest? We've got a 138 billion market cap. Yes, this is the largest of the seven that we will take a look at today. So again, 138.5 billion on the market cap. See the revenue chart there, a little choppy, not a little choppy, it is choppy. Looking forward, earnings estimates, EPS expected at 6.9% growth in 25, followed up by years of 8.7 and 8.8% on that EPS. And then you see the sales estimates there as well. So expected 28.7, let's say, billion on the revenue side for 2025, followed up by years of 31 billion and 34.5 billion. So that represents nearly 16, 8.3, and 11.6% growth year over year for the next 3 years. If you ever wonder why your utility bills go up every year, this isn't related to these companies, but insurance every year. Well, just look at the largest publicly traded stocks, publicly traded companies that are actually providing those services. There's a reason that growth estimates are consistent up and to the right every single year, right? At the end of the day, these are publicly traded companies, even though they are regulated utilities. Profitability is pretty solid here for NextEra Energy. Gross profit margin of almost 61%, net income margin just under 22%. And taking a look at the balance sheet, you'll see nearly 90 billion in debt on the books and 2.4 billion in cash. There's a lot of similarities that you're going to notice amongst all seven of these companies. It's going to be very steady and consistent, increasing earnings per share as well as revenue year over year. And then you're going to notice a significant amount of debt on the balance sheet of all of these companies. At the end of the day, they're regulated utilities. In theory, they can only raise prices so much every single year. And from a balance sheet perspective, there is significant capital expenditures required, from power lines to wells, water treatment, you name it, right? It's a messy business. It's a very capital heavy business. So the balance sheets are ugly, ugly, ugly for these seven companies. And maybe a reason why you're not interested in investing in them, or maybe you view them as a bond proxy, a bond alternative, the types of companies where everyone has to has to have power and water, right? At least in this country. And so you've got a customer base of millions, tens of millions, maybe hundreds of millions of customers that pay their utilities every single month. And you view these companies as, when I say a bond proxy, I say that because they all pay a dividend, and steady increases to that dividend, growth over time. Maybe that's more attractive to you than a bond. But got off on a tangent there. So dividend yield here on NextEra Energy, almost 3.4%, an annual payout of 2.25, and a 60% payout ratio. Actually, the 5-year CAGR on that dividend is very attractive at 10.4%, and it is a dividend aristocrat, 29 years of growth. Dividend growth history, I mean, It's beautiful, right? 2014, the dividend was 73 cents per share annually. 10 years later, at the end of 2024, it was 206. Nothing else I really wanted to cover here for now with NextEra. Moving on to Southern Company, the Southern Company. Over the past 10 years, up 108%, 5 year, 68.5%, and over the past year, 23%. Forward price to earnings, 21.4, and a dividend yield of 3.24, negligible short interest, also a massive utility company at a 100 billion market cap. Again, choppy revenue chart, and EPS growth for the next 3 years expected at 5.8%, 6.6%, and 6.9%. Sales growth expected at 4.1, 4.25, and 4.5% for the next 3 years. Profitability, let's say a 50% gross profit margin and a net income margin of 16.5%. Looking at that balance sheet again, 100 billion market cap, but you've got over 66 billion in debt compared to just 1 billion in cash. Already mentioned the 3.25 dividend yield. Payout ratio is elevated at 70.5%. 5-year CAGR on that dividend, 3%. So very slow growth to the dividend, but you are getting an over, let's just say 3.25% yield and almost a dividend aristocrat at 23 years of growth. You see the dividend growth history here, certainly not as explosive as NextEra Energy. 2014, the dividend was 208. 10 years later, it's just 286. So slow growth to the dividend and a fairly elevated payout ratio with that dividend distribution. So I wouldn't expect the dividend growth to really do much better than it has been doing at just 3%, especially when you consider the balance sheet holds over 66 billion in debt. The Southern Company is an electricity provider and natural gas as well throughout Illinois, Georgia, Virginia, and Tennessee. Something interesting to consider with utility companies is that very often their growth is inherently tied to the growth of the population in the areas that they serve. It makes sense, right? If you provide electricity and natural gas to a state like California and you have significant population growth, or Texas or Arizona or Florida or Tennessee or whatever, then your customer base is going to be rapidly expanding. If you're providing those services in certain areas of the Midwest or the South or wherever, and the population growth really isn't there, well, that's going to affect a company like a utility company in that region or in that state. So those were the areas that the Southern Company provides their electricity and natural gas to. NextEra Energy, it is fairly diversified across North America, but there is an emphasis on Florida, and they are based out of Florida. But again, it is spread across the country. Duke Energy here, ticker symbol DUK, trading at, let's say, 121, and towards the top of the 52-week range, 97.5 on the low end, 126 on the high end. Performed very well over the past year, up 24%. Over the past 5 years at 47.5%, and over the past 10 years, a little slow, but still 58% growth. Forward price to earnings ratio of 19.3, real nice dividend yield, a little over 3.4%, 1.5% short interest, and still another massive utility here at nearly 95 billion on the market cap. EPS growth for the next 3 years expected at 7.1, 6.3, and 6.6%. And sales expected at 3.9, 3.7, and 4.2% growth for the next 3 years. Gross profit margins almost 51%, net income margin 15.1%. Balance sheet is pretty disgusting, just as the past two were. So 85, actually this is even worse, 85.5 billion in debt, offset by just a couple hundred million. So very, very debt-laden balance sheet. Looking at the dividend, again, 3.43% yield. Payout ratio is elevated, just as we saw with the Southern Company. Annual payout, $4.18, over a 70% payout ratio. And again, just like we saw with the Southern Company, Payout ratio is above 70%, and you see that reflected on the 5-year CAGR of that dividend. In the case of the Southern Company, it was 3%. In the case of Duke here, it's 2%. 14 years of dividend growth. And you see it here on the chart, very, very flat dividend growth. And it's just the nature of the beast when your balance sheet holds that much debt and your payout is already above 70%. There's not a whole lot of room to grow. So, yeah, I mean, really hardly anything. In 2014, it was paying an annualized $3.15. 10 years later, it's up to $4.14. So not a lot of growth on the dividend, but the yield is a very nice 3.43%. And then in terms of what this actually provides, electric utilities and gas. So just like the Southern Company, electricity and natural gas, and Southeast and Midwest in terms of areas of operation. So certainly in the Southeast, that's been a booming growth region. So Duke has benefited from that growth. American Waterworks, this will be the first water utility. The first three were all electric utilities that we're going to take a look at. So AWK, American Waterworks Company, over the past year, up almost 17%. Over the past 5 years, 22.5%. And over the past 10 years, up an incredible 176%. Trading in the upper half of the 52-week range with 119 on the low end and 155.5 on the high end. It's at 146 today. Price to earnings fairly elevated at 25.5. Does pay $3.06 annually on that dividend distribution, representing a 2.1% yield, a negligible 2.35% short interest, and $28.5 billion on the market cap. Correct me if I'm wrong, if anyone knows, but I believe this is the largest water utility company. Could be wrong. But I mean, look at this, founded in 1886. That's kind of neat to see. But water and wastewater services throughout the United States. Looking into this, I thought it was kind of neat to see just how broad the services that it provides are in terms of not only what it provides, but the areas that it provides it. So water treatment plants, groundwater treatment plants, wastewater treatment, and then over 50,000 miles of transmission and distribution pipelines for water. 1,200 groundwater wells, 1,800 pumping stations. So, water utility services, you name it, American Waterworks does it. You see the annual revenue a little bit more steadily increasing than we saw with the first three electric utilities that we looked at. EPS growth for the next 3 years expected at 6.1, 7.4, and 6.2%. Sales growth expected at 5.7, 6.7, and 6.9%. Profitability, it's not great, but it's not terrible. Gross profit margin is 60.3%, net income margin 22.5%. Looking at the balance sheet, not quite as debt laden as the others we looked at, but still sort of the same story. So market cap's 28 billion. They've got 14 billion in debt and just, let's say, 150 million in cash. We already covered that 2.1% dividend yield, the annual payout of $3.06. Nearly a 56% payout ratio, but real nice growth that you've seen on the dividend, 5-year CAGR of 8.9% and 16 years of growth. So honestly, a pretty dividend growth chart here. $1.21 was distributed in 2014. 10 years later, you are up to $3 in 2024, so doubled it over the course of those 10 years. The other water utility that we were going to cover today, significantly smaller, both in terms of market cap and the area that it provides services. American States Water, AWR is the ticker symbol, 11% up on the 1 year, 3% on the 5 year, and up 110% on the 10 year. Trades for a very similar valuation that we saw with AWK here. So American Waterworks trading for 25.5 forward on the price to earnings. American States Water here at 24.8. It does pay a 2.3% dividend yield, $1.86 annually. Same short interest, but just a $3 billion market cap. So essentially a third of the size of American Waterworks. The EPS growth expected is 2.8, 6.1, and 6.7% for the next 3 years, with sales growth expected at 7.2, 4.8, and 3.25% for the next 3 years. Very, very similar margins for American States Water here compared to American Waterworks. And then you see here with the balance sheet, actually not terribly unhealthy compared to the other utilities we've looked at so far. Almost $1 billion in debt and let's say 27 million in cash on this $3.1 billion market cap water utility. Talked about the dividend yield and annual payout, a 56.5% payout ratio and nearly a 9% CAGR. So honestly, very similar metrics on a smaller scale to American Waterworks, and this is American States Water. 69 years of dividend growth. That's kind of neat. Founded in just 1929, just been around a little bit, but really it's a water utility focused on California and specifically San Bernardino County, which is I think that may be the largest county in the entire country, but a very large area of Central California. Talk to anyone from California, they'll tell you that's Southern California, but whatever. So yeah, this is American States Water. And that is the two water utilities I was going to cover today. You've got American Electric Power, AEP is the ticker symbol, $108 on the share price. Definitely towards the upper end of the 52-week range, 85 on the low end, 110 on the high end. It's done great over the past year, up 23%. It's actually up 17.7% year to date, so that's incredible considering how the market has performed. 33, that's kind of neat, 33.33% on the 5-year, and let's say 95% over the past decade. Does yield almost 3.5% on the dividend yield, 18.5 forward on the price to earnings. You're getting $3.72 distributed annually. Slightly elevated, but nothing too concerning, 4.6% on the short interest. And again, another massive electric utility here, almost a $58 billion market cap. So this is the type of company that is heavily invested in transmission lines, right? You drive across the country, you'll see power lines the whole way, obviously. And this is the type of company that gets involved with installing, maintaining, operating those electric utility lines. 1906, this company was founded. That's kind of cool. EPS growth expected for the next 3 years at 4.5, 7.1, and 7%. Sales growth expected at 8.2, 5.7, and 3.7%. Profitability, 47.3% gross profit margin, 15% net income margin. 46 billion on the in debt on the balance sheet, offset by only 418 million. So again, heavy capital expenditure. As you might imagine, maintaining a power grid is going to require significant constant investment. And that's another contributing factor to why utility prices increase every year is we got to pay for this stuff somehow, right? So again, almost 3.5% on the dividend yield. You're getting $3.72, 63.5% on the payout ratio. And that dividend's been growing at 5.7% year over year for the past 5 years. Back in 2014, you were getting just over $2 per share. Now you're getting $3.50 per share annually. And so in terms of areas of operation, it's the entire country for that power distribution. Last one here. You've got Consolidated Edison, ticker symbol ED, up 19.5% over the past year, 46.5% on the 5-year, and 85.5% on the 10-year, trading at the very top of the 52-week range. If we look over the past year, you'll see that it's been, I guess you could say, breaking out recently. Previous highs were around 108, and now you see it up at 113. Really, since year to date, it's been crushing, up 27% year to date. That's a nice little trend line for you. Almost a 20 price to earnings on a forward basis. You're getting $3.40 per share per year on that distribution, just over a 3% yield, and a 40.4 billion market cap. electricity utility here. So electric, gas, steam delivery, I don't know if that's still a thing, but operates throughout New York, New Jersey, and parts of the Midwest. Founded in, they claim, who's really going to check them on this, but claim that they are founded in 1823. Um, is, is that when Thomas Edison was alive? I don't know. Someone check me on that. EPS growth expected of 4.4%, 7%, and 5.9% for the next 3 years. Sales growth, revenue expected to grow at 3.8%, 5, and 4.5% for the next 3 years. Gross profit margin, 53.5%. Net income margin, 12%. So it's okay. Nothing crazy. Nothing great. So again, 40 billion on the market cap, 27.8 billion in debt, 1.3 billion in cash. Maybe you're noticing a trend. All of these companies have steady EPS growth, steady sales growth, all mid to low single digit. All their balance sheets are terrible. We got a trend going on with the utilities here. We talked a bit about the dividend, but you are getting that 3% yield, 61.5% payout ratio, and they've been growing it at just 2.25% year over year for the past 5 years. You do have 50 years of growth, so dividend king, that's always neat. 2014, you were receiving $2.52. 10 years later, $3.32 in 2024. So very minimal growth, but kind of makes sense. It's a utility, and they've been increasing the dividend for 50 years. Although the payout ratio is pretty healthy, especially for a utility at 61.5%. Here, you're seeing a chart of all 7 of these companies. Year to date, again, we already kind of talked about how well Consolidated Edison has been performing year to date, certainly leading the pack. Let's see. Okay, NextEra Energy, yeah, they're down 6.5% year to date, by far the worst performer. Consolidated Edison up 27%. But I mean, really, all of these, with the exception of NextEra Energy, have been performing well year to date. Sort of that flight to safety that you saw over the past month with some of the tariff stuff. Some people were selling out of your more higher beta stocks and looking for safety. Although really over the past week, that hasn't been working out too well. Over the past year, I guess we should really look at total return and not just price return. But over the past year, NextEra flat, Southern up 27.5%, Duke 27%, AWK 20%, AWR 14%, AEP 28%, Consolidated Edison 23.5%. Over the past 3 years, I mean, all performing well. The water utilities, not anything special. AWR only up 9.5% on the 3 year. AWK just 5% on the 3 year, but everyone's positive here. NextEra Energy just 4.4% on the 3 year. Top performer is, let's see, Southern. You've gotten over 40%, so that's your top performer on the 3 year. 5 year, you do have some solid dispersion. Very top performer on the 5 year is the Southern Company at 104%, followed up by Duke at 80%, Consolidated Edison at 75%, worst performer being AWR at just 12.7, 12.8%. And then over the past decade, you've got NextEra Energy that really pulled away from like the 5 to 10 year mark. They had some great years of outperformance. But anyway, NextEra Energy, your top performer over the past decade at nearly 240%, followed closely by AWK, that large water utility at 238%, the Southern Company at 220, American Electric Power at 173, Consolidated Edison at 165, AWR 153.5, and then bringing up the tail is Duke at 140% utilities. This kind of weighs all of it out. If you want to pause here, this is kind of a side-by-side comparison, but I think we covered all of this in our individual walkthroughs. And then you see the areas of operation there down at the bottom. But just wanted to break down a couple of the largest and best performing utility stocks. at least as of late. Different type of investment, certainly not one that you need to focus on if you don't want to, right? It's for a specific purpose, a specific strategy, goal type of investor, but not for everyone, certainly. I personally am not, but if you're interested, there you go. So thank you very much for watching. Maybe you got something from it. If you did, please give me a like, give me a subscribe if you want. If not, hope you enjoyed it. Take care. Bye-bye.